So before I even came out, starting at the VIP, I thought at least a half a dozen times in the last week to switch my flight. I was gonna come in on Monday instead. Super petrified about coming out, meeting a bunch of girls I didn't know. Truth be told, I came out because I had never been to Magic Kingdom. I didn't really want to come to Orlando and say that I didn't go, even when, like, it was free. So I was like, I should go. I don't like rides. Most of you know that what were with me on Sunday know that, but thank you. I came out because for Magic Kingdom, I got so much more. And I didn't even get a chance to meet Heather Carolina at BPCon because I was there for literally 48 hours. I thought about a dozen times before that about canceling out on it completely and making an excuse. I didn't want to travel to Cancun, but I went. I spent most of the time in my room or with just my panelists. I refused to go out. I actually even skipped out on my author signing because I just didn't want to go out and network and meet with people. This event is totally different. I absolutely love it. I gotta say that I'm often asked to go out to speaking at different conferences, and I'm doing the same thing. I'm like ruminating in my head over my presentation. I don't want to like meet people. It's exhausting. So I spend a lot of time in my room under the guise of, I gotta go work heads down, right? And that's just me self-justifying. But this one has been extraordinarily different. And I gotta say, like for Heather and her crew, the kind of event that you put on is amazing. The kind of connections, everything. Everything is curated for a very specific reason and intention, and you feel it. I usually come to events and give. I very seldom in the past couple of years get to receive, and in this one I got to receive. So thank you very much. So, all right, how does this do? A little bit about me, and that's just one of my kids, and it's actually really old. Oh, see, I pressed the button really fast. Because I lost my hard drive a month ago. That rains terror on you. I had to put together everything at the last minute. So my husband and I started a private lending business 10 years ago. It was nothing that I had planned on. We started with a couple of different investors and my husband's capital. He was just my business partner, my boyfriend at the time. And we just didn't plan it. It just exploded into something. We now lend and have capital from about 100 different investors that lend their capital through us, and we originate around 50 million annually in truly private capital. I'm proud of that. It's something that I never planned on doing. It has culminated into being able to be an author, again, something that I never planned on, and so I'm grateful for that. We do also own small commercial multifamily, mostly in Washington State, but we have properties in Texas and Nevada too. Truth be told, that's just a tax shelter. I'd rather use it as a down payment for a property rather than give it to the IRS. And so I was taking advantage of cost segregation studies and bonus depreciation, but I get very little value and fulfillment out of my rental portfolio. I'm just being honest. I also have a family of 5. It's blended. As some of you have heard from me in the past couple of days, I was divorced at 38 for the second time. I don't share that as a badge of honor. I just share it because it's part of my story. And I find oftentimes that the sexiness of the success that you hear up on stage needs to be, you need to fold in the crap that you waded through to get there. So at 38, 39, I found myself financially decimated. I actually ended the relationship with less net worth than I went into it. But if we turn things into blessings and opportunities, what it was is that I got to meet the love of my life. He was my very first and only date after I got divorced. I was just looking for a fling, and I heard he had a boat. And I'm not gonna lie, I just needed to relax. I was just looking for somebody who didn't yell at me, let alone anything else. So the blessing is I got to meet Matt Flynn. We bonded over real estate. Everything was similar, like youngest of 5, skipped a grade, grew up on a farm, we just, family did real estate as a side hustle. Everything about it just kind of aligned. And then he brought up private lending, and I'm like, what's that? I don't know what that is. And so I went home after a date, drinking copious amounts of wine, went back when I drank, on a boat, and I Googled what private money lending was. I had zero idea. So all of this to say that you can go through struggle, but you can come out on the other side so much farther than you've ever been before. The kind of connection that I have, and Heather and I were talking about this last night, far exceeds anything that I was actually just looking for. I was just looking for stability. I was just looking for silence, to be honest with you, and I get so much more. I mean, you can't spend 23 and a half hours a day together with a man and not have something. I want to kill him sometimes, but the business has kept us working on things because that's the baby that we created together, and it's the blessing and the opportunity that we get out of it. So that's just a little bit about my background. I will say also, it's this little amuse-bouche about me before we get into the meat and potatoes of private lending. It vacillates back and forth, right? Like you have like highs and you have lows. Those peaks and valleys, you just gotta roll with it. And what I find is that most women, especially working mothers, we never stop. Can't stop, won't stop, and you just keep plowing forward. But 2 years ago, almost to this day, I found myself at an industry conference, and my business partner actually literally and figuratively left me there. She was a guest in my second home there. She was a business partner. She was supposed to be running my private debt fund. She actually is my co-author, and she just left. And I haven't really talked about it until this year because I was trying to preserve not only like the integrity of the book or the opportunity that she gave me. I didn't want people to think I was speaking bad about her, but what I realized is that I've shielded myself from sharing my story about it because it's not about her. I had to accept full responsibility that at that time, and I also had a staff member who walked out, he literally walked out with his backpack too, at the same time. And my husband was having to get, a tumor, he's good now, but a tumor removed from his palate. And all of this was kind of bubbling up, and I'm like, I'm the only common denominator for all of these relationships that have gone awry. So at the beginning of last year, I decided to take a semi-sabbatical, which is not a real thing, it's actually an oxymoron. But the one good thing about all of it is that I started reading a book called The Mountain Is You. If you haven't read it, I highly recommend it. You did. It's a game changer for me. It literally changed how I viewed my relationships, and not only that, but how I viewed myself. And why is that important? We talk about making different changes and pivoting in our professional environment, but we could keep leading ourselves back to disappointment. We don't realize we're the ones that are self-inflicting it. So it's not Alex's fault that I offered to bring her into my fund. It's not my staff member's fault for me seeing potential in him that he didn't ask me to give him. A lot of these things related to my self-worth. And so the whole concept behind The Mountain Is You is really about turning self-sabotage into self-mastery. We just don't know we're doing it, ladies. I didn't realize that I was pumping my energy into these people in my business, in my personal relationships with my ex-husband. I was just pouring everything into them because I felt like they wouldn't love me if I did not do acts of service for them. How so wrong I was in putting myself second. So read The Mountain Is You. There are opportunities that come from having that happen. I now have an amazing fund manager who's just the greatest business partner. I have a renewed sense of clarity and confidence in where I stand in professionally in this world. I'm still trying to figure out who I am. I think that's an existential crisis we all struggle through in our middle age when we put everybody else first. But I'm okay with it. But now I know that I'm gonna not stop making these mistakes with relationships, with people, self-justification that allows me to stay in my room because I have to work, because I should be down here mingling with all of you. I know that now. So that's why I'm here and that's why I'm on this stage. So just thought I'd let you know, The Mountain Is You is wonderful. In the last 24 months, it's been a lot of breakdowns, but some serious breakthroughs. So I hope it's good for you too, and maybe it'll be part of your book club. So private lending. We often don't talk about it in terms of being the bank. You guys often talk about it as an active investor in terms of how do you raise private capital. I just want to give you a little bit of a different outlook on what the other side of the real estate transaction could be for you. Because you could be this guy. This is Patrick. He's one of my borrowers. He actually sublets some office space from us too. And what he does is, it can be fun, it can be exciting. Some of you get the dopamine rush from finding new properties and getting, the dirtier the better. And that's great, but you could also do this. Nothing super sexy about it. Sure, it's Instagrammable, whatever, but I'm still getting mailbox money from it, which is kind of fun. But we don't often talk about it, especially, when the onset of bigger pockets and stuff like that, because we just don't, private lenders don't make splashy headlines. I'm not gonna come up here and tell you about how I made 7 figures on a flip or how I got to 1,000 doors in 2 years. I hate those kind of superlative headlines. I just wanna make private money, passive income. I wanna have like passion and purpose over profits. I would rather have profits over my profile. So if I'm not gonna monetize my and have a whole bunch of followers, I don't care, I don't need that. I just wanna make money quietly and safely and securely. So this is what I choose, and hopefully I'm just gonna whet the appetite that you might have for looking at real estate investing just a little bit differently, because I don't think that we often talk about it. But eventually you'll probably get there. It's just a matter of time. Time right now is an excellent time to get into private money. Why? Interest rates went up at the beginning of 2022 and things started to spiral out of control a little bit for people. For flipping, you just didn't have a whole lot of margins. Inventory was low. There's a ton of competition out there with everybody wanting to learn from Bigger Pockets and YouTube and figuring out that they think they can do it too, especially watching HGTV. But it's really changed now. And I've heard a lot of flippers having to come to the table with cash to close because the margins just weren't there and they were utilizing volume flipping. From syndications also is a little bit of a challenge because you have variable rates and then your GPs just aren't really able to, for the disposition is much, much more difficult and the stabilization of those asset classes than they were now. So at best, you're getting capital calls. At worst, some of your GPs are going dark on you. And so you're looking for less speculative ways to invest your capital into real estate. Buy and holds also is a little bit less attractive. You can still find good deals out there. I'm not saying that that's not true, but a lot of people like buying rentals because they want the cash flow and they also want the depreciation benefits of it. Right now, today we'll find out whether or not we'll still continue to have bonus depreciation, but right now it's on a phase out. So next year you really can only depreciate up to 40% in year 1, and so it's much, much less attractive. And so things just aren't cash flowing with higher interest rates. You don't have that depreciation benefit of it. It's just not as good of an option as it was 5 years ago. Note investing, same thing. You're buying notes, but really being able to get into them at an attractive discount is becoming fewer and far between. So private lending on the flip side of that is experiencing a boon. Why? When interest rates go up, that means the disparity, the delta between what you guys can go out there and get for hard money or conventional lending and what we lend out as, it shrinks. So I can command much higher rates. My average borrower note rate right now in my private debt fund is about 13.5%. And that's not including the points that we take on it too. So that's easier to charge when it's going to cost you 6.5%, 7.5%, or maybe 8.5% to 9% for a DSCR loan. So as a private lender, this is actually a really great opportunity for me to be able to carefully select loans that I can fund and still make a passive income with a very large equity buffer in that loan to value to help protect me. What is private lending? I just want to clarify a little bit about the difference between what private money is and what it means. It's really just one business entity, just like an LLC or an individual, lending out to somebody else. I like to put some confines around that it's business or commercial purpose, so you're not exposing yourself to licensing requirements for consumer protection. It's also secured by real estate. There's a lot of talk and chatter out there in certain paid communities about lending on earnest money deposits and doing unsecured loans. I don't recommend that at all, so I want to put some confines around that. And then it's short term as well. So we're lending typically to real estate investors. And then why would you do it? Well, it's just easier, right? When you're trying to get money from a hard money lender, can anyone get a second lien position loan from a hard money lender or a conventional lender? Only want first. And the rationale behind that is that their money comes from Wall Street. Institutional lending backed by banks, backed by institutional lenders, they want the security of being in first position only. As a private lender, I have discretion. I can do whatever I want. So there are instances where we'll put second lien positions on your rental property because I know that as a self-employed investor, it's much more difficult for you to get a HELOC. So why don't I put a second lien on that and then I'll put a first on your new acquired property. Then it can help you burr out of that. So we can be creative as private lenders, and that just creates a space that there's a need for that. Doesn't matter what market climate you're in, there's always going to be a need for that. And so I love being able to be in a space where I can kind of stand the test of time. You know, it's a little bit more recession proof. And I'm finding now in the last couple of years, people are talking about it more and more. It's just a more attractive in a market that's more stabilized. You just cannot rely on appreciation like you were in years past. So new investors are shying away from wholesaling or different activities like that because they don't want to go door knock. They don't want to have the expense of, you know, putting a lot of cold calls out there. Private lending seems like an easy way to get into real estate. Partner up with somebody and learn as they do their project by being the bank. Busy professionals like it just because it's a lot less active than owning real estate and flipping houses. And then there's less speculation, as I mentioned again, compared to syndications. Retired landlords kind of make up a huge bulk of my clientele that invest in our debt funds. A lot of them don't have family members that express any interest in their real estate portfolio. So for estate planning purposes, they want to liquidate that real estate, but they don't think that they can last long enough. They don't think they'll live long enough to survive the next, you know, stock market crash. So what they know is real estate. So investing in private lending seems to be an attractive transition out of active investing over into a more passive role. And then a lot of people like using their self-directed IRAs or their solo 401ks to invest in private lending because, again, it's a little bit safer. You don't have the necessity to have some of those, you know, depreciation benefits because it's a tax-deferred vehicle. So investing your retirement plan is an easy way to, again, help your money make more money. So it doesn't really matter where. I just feel like everyone starts out in real estate in different places, but you eventually end up in private lending. You eventually want to be the bank because it's the easiest way to do it. And especially for all of you that are already actively investing in real estate, you're actually parlaying your skills over into a different way to invest much easily than you would, you know, from the very beginning. Because from a lender's point of view, we underwrite your deals exactly like you do as active investors. We might be a little bit more conservative because we have less control over the outcome of that, but we still look at it exactly the same way that you do. So the transition is quite easy. So when your kids get older, or you start a family, or you just you get burnt out, or your give a damn is busted, and you just don't want to do this anymore with GCs and PMs that walk out on you and stuff, you're just, maybe I'll do private lending because then I have a little bit more autonomy and control. And what we all want as women is more time freedom. It's the one thing we can't buy. So I like the fact that I can do it on the beach. I like the fact that I can underwrite loans in the car or review loan docs while I'm waiting in the parking lot for my kid to get out of soccer. It's something that you can bring with you everywhere. I don't ever have to go onto that project site, not unless I absolutely need to, and seldom do I. Most of the time, I don't even see it before we even fund the loan. So the power of it is that you can have an extremely high rate of return. Again, right now, the cost of capital, even for hard money lenders, conventional lenders out there right now, it has doubled. We took, well, I guess prime dropped by 0.5 point a month ago, but interest rates went up. So right now, you can command, depending on what state that you live in and where you lend on, double digits easily. I have some of my students that are lending out and they're charging 5 points and 15%. That's a 20% annualized return. He doesn't have to do a single thing. But the nice thing is that you can charge whatever is commensurate with the risk involved with the project, and you can charge whatever the market will bear. So it depends on the market that you're in. In Washington, it's very common to get hard money rates at 12 and 2 in first lien position. Nobody does second lien positions, so I can charge 3 to 4 points and 13 to 14% easily across the board. And I get to call the shots, so I'm only allowing for a max 70% combined loan to value. That 30% equity protection is going to be my saving grace if things go sideways. You also get CD-like liquidity, because most of the time we're lending to real estate investors who are doing cosmetic flips. That's going to be, 4 to 6 months, maybe 8. So I get to call the terms, and you have this CD-like liquidity, but then you also have, so you can get it back. So it's a great diversification tool in there for you. And again, it's secured by real estate. I really cannot impress this enough. You have to have some sort of security instrument to protect you that's recorded with the county or the municipality that the property's in. In certain states, this is going to be a deed of trust. In other states, it might be a mortgage. The only difference between the two is that a deed of trust, or a trust deed as it's called, would have a trustee that helps be responsible for the conveyance of the loan afterwards. And a mortgage, you don't. It's just between two parties. But essentially, they're the same thing, but you can record it against the property, and they cannot transfer title or sell it without paying you off. That's the important thing. So the other things would be, again, that it's highly flexible. You can call the shots as long as you're doing something legal, but we're in a highly unregulated industry, which gives you an incredible amount of flexibility in what you do and how you do it. You just have to know what states that you shouldn't be lending in and what those requirements are, but there's just a wide variety. That nuanced industry can make it difficult to figure out your space and where you want to be in, but the flexibility can be a great thing, because depending on where you're at, you can choose loans that are much more safe and secure. If you're younger and you like the risk and you totally understand it, you can go for higher returns, and you can go for higher risk projects because you were developing before, so you know construction projects in this zip code very well. It's extremely nuanced and flexible. So how do you be the bank? There's several different ways you can do it. You can DIY it. That's what I teach in my book. Here it is. I actually spiral bound it because I got that idea from a reader. But the book, it's like 300 pages that tells you everything about how to find and fund a private money loan. You don't have to do it by yourself, though. You can work with another private money lender. Chances are, has anybody lent private money here? See, there you go. Any meetup you go to, locally, nationally, you're going to have active investors who have actually private lent before. So they may have access to deals that they can't fund because they have limited capital resources. Working through one of them could be a possible solution, so you could work your way through it, understand and learn the ropes with the help of somebody else. It also gives you access to deal flow. The other option would be a direct private placement, and that would be working with a company like us that actually has a business brand out there. We have maybe a brick and mortar, we have constant deal flow, and we utilize other people's money to lend on these projects. I didn't start out just with a debt fund. I started out private money matchmaking. So if Michelle had $100,000 to lend out, she only wanted single family fix and flips that were cosmetic, I would find her a loan that was within $100,000, and I would package it up together, give her the opportunity to review it. If she said yes, those monies would be tendered directly to title and escrow once the legal documents were prepared and reviewed by her and by our team, and then away you go. There's some challenges to that, and we'll cover it a little bit later, but working through a broker can be a better way for you to be able to deploy your capital without having to go out there and seek out your own loan. But chances are, if you guys are all in this room, you're perfectly comfortable going to meetups, you're perfectly comfortable meeting and engaging with other real estate investors. Probably is not difficult for you to find somebody who wants your money. Because when you're a private money lender and you stand up and get the needs and wants and say, I'm a private money lender, I got a couple $100,000 that is just sitting here, and I'd like to partner up with another investor for their fix and flip and maybe fund their deal. After you say that, you're the most popular person in the room. You've got like 5 people coming up wanting to know if they can tell you about their projects. It can be a little overwhelming, and I can help you with that, but it's not hard to find deals for women like you in this room. And then the most passive route would be investing in a private debt fund, much like a syndication, only it typically has shorter lockup periods, less speculation, and we place loans in that fund, not real estate. So the loans become what you basically invest in, and you get a passive return on that. When you do it yourself, you get the points and you get the full interest rate, right? You get to call all the shots, full autonomy. If you want something a little more passive, a little bit more help, you're going to give up a little. You might give some interest spread. So instead of getting 12%, you might get 10. The broker or your partner might take the points on it. I don't know. It just depends on what you work out. And then when you get all the way down to the debt fund, where you're just kind of underwriting the fund, the portfolio, the fund manager, you're going to have sometimes a fixed rate. Sometimes, they call it a preferred return. And so you're going to have some diminished return, but it's going to be continuous for you. And you don't really have to do a whole lot, because they're finding all the funds. There's diversification across a whole portfolio. So it can be a safe way to invest without having to do as much work. So it kind of just depends on how much time you have. how much effort you want to put into it, how much know-how you have. If you're just starting out in real estate, maybe you don't want to have to go out and find your own and place all your capital into one deal. I know many people who prefer to spread it across multiple deals, so they prefer being in a debt fund because it's better risk diversification. It's completely up to you. So a little bit more about DIY funds. Again, full autonomy over it. You get the origination fees. It really just depends on how much you want to charge, how much you want to charge for an interest rate, and how much the market will bear. But essentially, you're the key decision maker, right? So if we're talking and you want to borrow money from me and I say it's going to be 12 and 3 and you agree, then that's basically it, as long as your attorney tells you it's legal, right? So a lot of people like it for the full autonomy of it. And again, pretty simple to do when you're already a real estate investor. And what a lot of people like about this is that you don't have to be accredited to do this. So if you only have 50K, and I put that in quotations because 50K is hard to spend in a lot of markets, right? So you have to be kind of careful, but it's still a lot of money that we saved up. So if you only have 50 and you don't really match the accreditation requirements, you still can lend it safely on a project without it being deemed as security. So a lot of people like being able to do private lending this way because you don't have to have that accreditation. So in the book, we talk about the CPR lending system. This is what we introduce in there. And they're basically the steps in which to find and fund a loan. The C's represent each step. It starts with calculate and evaluate. To me, this was really important because it was a personal assessment. What are you trying to get out of this? What are your financial goals? What do you know? What don't you know? What's your risk tolerance? What are your personal goals and your lifestyle goals? Because private lending can get out of control really fast. It can go from passive to active in a heartbeat because, again, you're the most popular person in the room and people will start coming to you and say, can you lend my money out? And so you really have to set some guardrails up front just to preserve yourself. And that to me was really important to put in here because if you're going to be active, then you might as well be out flipping your own houses and running your own short-term rentals, right? So we want the calculate and evaluate in there to just set parameters of what makes you feel comfortable to lend on, what wouldn't make you sleep well at night. It's important to identify those things. The connect phase is where you go out and create your virtual team from real estate investors that you could potentially borrow or lend to, I should say. A real estate attorney that's really experienced in private lending, title and escrow professionals that can help support you, people that can provide valuation support. Private lending is a team sport. You don't want to do it alone. So before you even go out there and raise your hand and say, I've got money to lend, you got to put a team together. You need to be educated on it. You need to have legal counsel on it, someone that can back you up. And you need to make sure that you have resources because funding a loan happens quickly. We all want those funds yesterday. So you don't ever want to drag a borrower on and really threaten their ability to close by their closing date. You want to make sure that they're able to fund it and that you feel comfortable. So you have to have that team together. Then you go out and contact your borrower, you pre-qualify it. You want to make sure that it is business and commercial purpose and use and not being used to pay off medical debt and stuff like that. You want to pre-qualify it that the property is acceptable to you to use as collateral, and you want to make sure that you understand their exit strategy because that's really important to make sure you get your capital back. We're talking about capital preservation, not really return on investment so much as return of principal here. So all the C's represent the entire steps along the way. Compile and condition is really what we call in the traditional mortgage world is loan processing and loan underwriting. This is where you collect a lot of borrower documentation. We talk about it in the book to help you understand what kind of documentation you should be asking for, how to look at it, what you should be seeing as red flags. The compose and close is where you work with your attorney to have your legal docs for your loan prepared, and then you have a title and escrow company or an attorney, depending on the state, actually fund it for you in a safe manner. And the convey and collect is the fun part because that's where you just have your mailbox money, and then when you finally receive your principal payoff, then you're able to take that lien off of the property and rinse and repeat. The P's in the CPR lending system really cover all the people, the property, the paperwork, every step of the way, because each step you're going to be doing something slightly different. In the contact phase, you're going to be working with your borrower, but in compose and close, when you finally have underwritten the deal and you're ready to fund it, you're going to be working hand in hand with your title officer and your escrow closer and your attorney. So we cover all of the things that you're going to need related to the person, the property, and the project. You're going to do light level evaluations up front on the property and making sure that it hits a certain LTV. But then you're going to be much, much more detailed when you go into the actual underwriting. We cover all the P's for each one of those steps. And then we would be remiss if we didn't talk about the risks and rewards, because every real estate investing strategy has risks. And I felt it was super important to make sure you understood that if you skipped something, if you did something wrong, or if you all of the war stories that I actually had to go through for the first 10 years of our business, I wanted to put that in there so you could weigh the pros and cons and really evaluate where you come in at. Because again, the entire strategy behind private lending is to allow you to sleep well at night. We can actually do active investing, self-storage, syndications, RV parks, glamping. We could do that if we wanted to put forth the effort, but you make the conscious decision to go into private lending because you want it to be passive. So the risks and rewards really helps you fine-tune where you land, because it's very personal. The way I'm going to lend is going to be completely different than the way that you guys might lend. And I want to give you perspective in the book to make sure that you understand where it is that your risk tolerance lies. So a few things to consider is that there are about a dozen states that actually do require licensure. It's a little bit quirky depending on the state. Some of them are basically, 1 to 4 units. Then it would have a licensing requirement. Some are slightly different than that. But what's important is that you find an attorney in the state that the property is in, or the state that you live in, and get educated on it. Some of the prompts that I would use trying to find one would not just be real estate attorneys, because I've seen real estate attorneys draft really crappy promissory notes. They don't delve in that. They do other types of real estate transactions. Find a firm that has a practice area with asset-based lending, private money lending, creditor rights, foreclosure. Those are the types of private lending law firms that you would want to go after. I'm sure they do other things in real estate, and that's fine, but you want to be very specific about whether or not they have the true expertise in private lending. Asset-based lending, private money lending or hard money lending, creditor rights, foreclosure. I've also seen banking and finance. And you can use, any of you guys use AI to help you? Perplexity.ai or Claude.ai, ChatGPT, you can actually punch in there. Find me local real estate attorneys experienced in private money lending or asset-based lending in Charlotte, North Carolina. I did that for one of my coaching cohorts. It actually pulled up some phenomenal results, so try that too first. But just know that there's some state-by-state requirements. Usury and securities too. They vary state by state. Private money lending is not governed by federal law. You need to understand whether or not you have usury implications. There's a few people here from Tennessee, I think. Tennessee is one of those odd states that even if you do business purpose loans, you're bound by usury law. And in that state, you actually are bound, it's like prime plus 4. So it's good right now. It's, I think at its top, like 12.5% that is what you could charge. I think right now it's like 8.5 because prime dropped by it's something like that. And it affects business purpose loans where most states usury exemptions are applicable to business purpose loans. That's why we only do business purpose loans. But usury is basically just a cap in that state that tells you this is the max that you can lend on a particular in a particular loan instance. Again, most of the time business purpose loans are exempt, but you still need to know what that means. And then securities as well. Sometimes in some types of lending requires you to follow securities law. If I was going to go and pick someone at random from this table and we were going to co-lend together, many states deem that as a security. You cannot lend with people that you do not know and have it not treated as a security in some states. But in my state of Washington, I can lend just myself and it's not a security. I can lend with my best friend or my parents and it's not a security. I commingle that with people I don't know and then it's a problem. So just make sure you understand usury law within your state as well. So what does this look like? a fix and flip acquisition, somebody wants $100,000 and you want to charge 12%. So there's an annualized return, which means at 12%, that means your monthly interest-only payment is $1,000 a month. And by the way, there's a addition mistake in here, and that's pretty common with me. Despite being in financial services, I'm a words girl, not a numbers girl. I'm the girl that gets yelled at because I try to double down on a 9 and a 3 at the blackjack table. The actual total income generated here is $18,000. It's not 16. I screwed up. But this is for illustrative purposes. You have an annualized interest rate of 12%. Maybe you charge 3 points for loan origination fees. And by the way, ladies, you can charge all of the fees for your attorney, through using a third-party servicer to service your loan. Charge it back to the borrower. They're very accustomed to doing that. Conventional lenders do that as well. We fold that in. So if I'm going to charge 3 points, I will also charge them over and above that for the $600 to $900 it costs to have legal documents drafted up by my attorney. I will charge them and pass through the $50 or $100 it's going to take for me to initiate and open up an account with a third-party servicer, so I don't have to make those payments. So 3 points is what you're going to charge. We're going to say it's only 6 months. So basically, if you find 2 loans back to back, you get to do 2 loans a year. So that's where you get the total income generated at $18,000, not 16, $6,000 in origination fees and $12,000 in monthly installment payments. And so your cash on cash when you do it yourself is going to be 18%. Again, I screwed up. But if you were going to broker it or use a business partner like another private lender, you're going to have some diminished returns there. They may take all the points because they're doing the work to find you the loan. They may take an interest spread. So if they're going to charge 12, they may pass only 10% over to you, and they're going to keep it 2%. It's pretty common out there. But you're going to have that support and that guidance from somebody, hopefully that you know and trust, and you are, have a cultural fit with, and you like their business model with, to take on that diminished return. But just know that there's a lot of different ways to do this. You obviously are going to experience your highest cash on cash doing it yourself, but you can get the help of others at a cost. One thing I want to say about private lenders and partners and brokers that you'll work with, when you're working with these pros, there's a lot of different considerations here. You need to understand how they get paid. I just mentioned a couple of them. They're probably going to take your origination points, and they're probably going to take an interest spread. Ask them what it is. Ask them straight up, how do you make your money as a business? It's important for you to understand that, and it's important for you to understand how you'll get your interest return as well. How do you structure your loans? There's a lot of different ways to structure loans. You need to understand that broker's business model. I mentioned one and how we do it, where we would do whole trust deeds. I placed Michelle directly in a loan with her name on the trust deed. My name's nowhere on there because I'm the broker. I'm facilitating that relationship, but she gets to call the shots on all of it. There are a number of different ways to do it that are less secure, in my opinion. There are things like loan participations, which is just a JV, a legal agreement written up to allow you to participate in a loan. People often sell their loans. There's things called hypothecations. Hypothecations mean basically note-on-note investing. When Michelle funds her loan and then she goes and pledges it to somebody else, she pledges that note as collateral. So no longer is that secured with real estate directly. It's secured by a note. And while that can work for some people, there's a lot of precautions you should take on that. And there's a lot of ways for the broker to screw up. So you may not be underwriting the loan necessarily, but you still have to underwrite the private lending broker to make sure that they're doing things above board and that you understand how they're operating their business. You also want to know if they're servicing it or if they're outsourcing it, what kind of lending guidelines they have, because ultimately you want them to back into your risk tolerance. You don't want to see that they're 100% loan to purchase price, 100% of rehab costs, and you're like, where am I being protected? How does that work? You don't want to see that they're going to place you in a gap loan so that there's 100% loan to value and no equity protection to protect you. Ask the question about their lending guidelines. Because if you don't, there are situations where things can happen. This year, and I'm just using 2 examples from Canada because it's extremely prominent up there right now, where brokers have gotten into hot water. The guy in the top was originating bridge loans and selling them. They did not exist. So it was an absolute Ponzi scheme. He was based, I think, in Victoria, BC, and that was earlier this year. The one on the bottom happened to be a very prominent mortgage broker, a woman who was well known in the real estate community, like in the Ontario area. She funded a ton of loans, hundreds of millions of dollars of loans a year. She did hypothecation. When she went and lent out a majority of her funds to a childhood actor, who's actually American-born childhood actor in Canada, and opened up a bunch of companies, she lent tens of millions to him. Her concentration risk with him was excruciatingly high. He misappropriated funds. He posted a lot on Instagram on yachts and stuff like that. He went into file for bankruptcy. In turn, she had to file for receivership. If you look at the bottom there where it says promissory notes and the outstanding claims from creditors, almost 90 million. Most of them were note-on-note investing. She did not directly place these people into loans with their names on the security instruments. So you do have to underwrite who you're working with as much as you underwrite the loan. So there's some risk there. And again, I'm not trying to scare you. I'm just trying to make sure that you understand that you can't work with people just predicated on a personal belief or trust or feel. You know, I love my best friend, but I don't know her credit score, and she doesn't share her performance reviews at work with me. So like, how well do you really know, right? You have to look a little bit deeper. And I think that we give people that we know a little bit more leniency because we're like, wow, I see him on Facebook, or they seem really successful. I've known him for years, or like my brother. But you don't really know. So we tend to loosen up our requirements for them because we think we have a personal relationship. Don't do it. You just never know, right? I never thought I'd be standing here on stage, never talking to my co-author again. You just don't know people. So in a private debt fund, again, very passive, but you have to go into it eyes wide open. This is a vehicle where you're getting a participation in a pro rata share of the interest income being earned in that portfolio. It's a great way to invest, but there's some considerations that you need to take as well. Who here invests in syndications? Anybody? Not that many, actually. Okay. Syndications are great. This is similar, like I mentioned, but what we don't understand sometimes as LPs is that there's senior debt that's preceding your capital investment in there. And that's what's troubling with syndications right now, is that senior debt is maturing and the GPs can't get out of it. The interest rates have doubled, or and the cap rates are not matching up to interest rates, and so they're getting into hot water. Private debt funds can be the same way. There are a lot of debt fund managers out there that will pledge the notes within their portfolio as for a warehouse line of credit with an institutional lender. And so you might want to ask, is this debt fund levered? It's important for you to know, is there any debt on this debt fund? Because it can acquire debt. We don't lever our fund. I'm trying to make sure that everything is excruciatingly simple and safe for our investors, and they still remain in a first lien position, so to speak, on the notes that are protected in there, but not all of them do. So it's really important for you to understand what the risk potential is in there and how they manage their fund. I could go into a lot of detail about how, but I would think that maybe you should use the QR code and read an article that I published on Bigger Pockets about it. There's a lot of standard things about a debt fund that you need to be aware of. Not only about their return, but you want to make sure that you understand their financials. The reason Ponzi schemes exist is because people cook the books. People can't, they can. It's a lot harder to cook the books when you're using third-party bookkeepers, third-party accountants, third-party audits. So it's really important that even in a syndication or in a private debt fund or even with the broker, figure out who's operating those books. This is an example of another lender. I can't remember where it was. I think it's in the East Coast. But again, they cooked the books because they kept all of their financial operations in-house. And it can be really difficult to get out of if they're not utilizing third-party resources to protect your investment. So I encourage you to check out the QR code for that article. But I just wanted to give you a little bit of overview on private debt funds and how they work. But if you wanted to do it yourself, which is where I would think that all of you might want to start so that you can maximize your return, here's just some quick tips for you. One is get educated. Again, I can only skim the surface. In 300 pages of the book, I'm still having people come back and ask, even though it's comprehensive with checklists, with tools, with templates, the full meal deal in there, there's still a lot to learn on it. So get educated on it. There's Facebook groups about it. I have one called Lend to Live, a private lender collaborative. There's books on it. There's coaching that you can get on it. But just get yourself educated before you get in the middle of a loan. I think we get FOMO and we want to get our capital deployed really quickly, and then all of a sudden we're dealing with a heap of crap after the fact, and then we're concerned. Do it up front. Educate yourself up front, because it's a lot cheaper to get an attorney to draft your loan documents than it is to retain an attorney to defend your position afterwards. Build that virtual team. You cannot do it alone. You cannot know everything there is about title defects. I promise you, there's a ton of them. And you need a lender's title policy to protect your investment. Your title officer can be one of your really good friends. A real estate attorney is one of our closest allies. He looks at every deal. He reviews my title commitment. He advises me on whether defects are appropriate to bypass or whether or not I should work with them to get it cleaned up. So you really need to create a virtual team. And then outline your goals. As I mentioned, it's really, it can get carried away really fast. I'm up here talking about creating passive income on private lending, and I run a full active business. I'm a total hypocrite. So you want to make sure that you actually understand what it is that you're trying to achieve out of this. Really, really important. It's about the lifestyle. It's not about the income. So set that out in advance so that you can make sure that private lending actually fits into what you're trying to achieve for yourself and your family. And then again, define your elevator pitch. I didn't really talk about this much in the past, but you cannot get up and just say, I have private money to lend. You have a fixed amount of income to lend. You have a very specific idea on what the ideal project should look like, who your customer avatar should look like. Refine that message so you can find the right person, because investors will talk your ear off. They'll want to talk about their deals until you turn blue. Figure out that you want to work with a landlord who does buy and holds with value add components to it, or maybe you want them to be stabilized, or I only want to work with short-term rental operators because that's the space that I know. And you have to articulate what it is that you're looking for up front so that you're not inviting a whole host of people to try and sell you on funding their loans. It's a little bit of a waste of time if you don't do an elevator pitch. And then retain an attorney. Again, I've spoken about this, and I can't speak about it enough actually, but I've talked about it enough. There's a lot of ways to screw up. You need a private lender to make sure that they can educate you on what you can and can't do and to help protect you up front, not after the loan is funded. So find a private lending attorney. It's a bonus if they will do title and escrow. Quite a few of them will. It's a bonus if they'll advise you on specific loan concerns. I have my attorney draft up every single one of my loan docs. Sure, I could have him do a boilerplate and I could enter it in myself. I don't really want the hassle or the concern about fat fingering it and screwing it up. I've seen trust deeds that could not be enforceable because they were written wrong. The borrower signed it as a member, but they signed it as an individual. It should not have had a member written on there. And that was one that came from a paid community where they were just throwing docs out there for people to use regardless of what state they're in. And so there's ways to screw up on that. I like my attorney to draft all mine up. And it's also a bonus if they'll act as your trustee. I prefer legal representation way more than a title and escrow. A lot of people think that they can get title and escrow to just draft up the prom note and the deed of trust, and they will do it for you, but you have no other protection measures in there. Who's going to get your hazard insurance policy for you with you listed as a mortgagee? Who's going to help get you that lender's title policy? Most title companies will actually write up your prom note and your deed of trust, and they don't even ask you, do you want a lender's policy? It's crazy town to me. You need that as protection. And there's a whole host of other documents that help shore up the legal aspects of it, that it's business use, that it's non-owner occupied. You need to have that, and a title and escrow company is going to do it, so an attorney will. So those are just my quick tips and tricks. And again, probably a lot of information through a fire hose. I just wanted to skim the surface on it just to give you some sort of idea of where private money lending, being the bank, could fit into your personal journey as a real estate investor, no matter where you're at. It might be now, it might not be. It could be down in the future when you're looking to sunset on your real estate investments and retire with your husband and go travel around for a year. That's my goal. And so you just never know when private lending can fit into your strategy, but don't keep it as something, as an idea that's just too far-fetched. It's something we can all do. Thank you.